Brian asks, if my income means I pay 5% tax in a financial year and I am liable for CGT in that same year, is my capital gains tax paid at that same 5% rate? An interesting question. I had a conversation with an accountant about this. So what you're saying is your average tax rate is 5%. But if you're paying tax, your marginal tax rate is at least 21%. So Brian, what you're saying is that you are paying some tax. You're paying 5% tax. So let's say, for example, you potentially got a taxable income of $30,000. You can earn up to $20,500 and pay no tax. Income over $20,500. The reason that is different to $18,200 is because there's a low income tax offset that you can get. So anything over $20,500, you pay some tax on. So you've got a taxable income of over $20,500 because you're paying some tax. You potentially got a taxable income of around $30,000, which means if you include the Medicare levy, you're paying 21.5%. So you're paying 21% tax on the money earned over $20,500. So whilst your average tax rate is 5%, your marginal tax rate is 21%, or if it's up into the over $37,000, it's 34.5%, including the 2% Medicare levy. Making these types of contributions to super, either salary sacrifice or personal deductible contributions to superannuation, even though your average tax rate is 5%, can still be of benefit because you're reducing your tax rate from either 21 to 15, the contributions tax rate, or if it's 34, you're reducing it to 19.5. So don't look at average tax rate, look at your marginal tax rate, and that's going to drive your decisions. Average tax rates are often confusing. So hopefully that's answered your question. So it could actually be a CGT, if you are paying some tax, is payable and could potentially be managed through some of the strategies that we've talked through earlier.